Welcome back to Profit Pulse. If you watch part 1 of this series, you know the timeline. You know what happened on February 28th. You know about Operation Lion's Roar. You know how oil spiked, how markets reacted, how airlines got crushed, how defense stocks surged, and how the Strait of Hormuz became the most important 33 kilometers of water on the planet. But here is the thing about part 1. Part 1 was the surface. Part 1 was the what. And the what, as dramatic and as market-moving as it has been, is actually the easier part to understand. Part 2 is about the why, the deeper why. The why that most financial media is not talking about because it is complicated, because it is uncomfortable, and because it requires stepping back from the daily headlines and looking at this conflict through a much wider lens. Part 2 is about what is really happening beneath the surface of this war. It is about the hidden geopolitical strategy that has been building for years and is now expressing itself through military force. It is about the global power dynamics that are shifting in real time and will continue shifting long after the last missile of this particular conflict is fired. It is about the silent wars being fought in digital spaces that most people do not even know exist. And it is about the specific scenarios, the specific signals, and the specific strategies that serious investors need to understand and act on right now. Because here is what I want you to hold in your mind throughout this entire episode. The 2026 Iran war is not the story. The 2026 Iran war is a symptom. It is the visible manifestation of forces that have been building for years, forces that are bigger than Iran, bigger than Israel, bigger than even the United States. Forces that are reshaping the entire architecture of global power, global trade, and global finance. And if you can understand those forces, really understand them, not just at the headline level but at the structural level, then you will have an analytical edge that very few investors actually possess. An edge that could be worth an enormous amount over the next decade. So let us go deep. Let us go places that most financial channels will not take you. Let us talk about the bigger war that nobody is talking about. Part 1 of this episode, this is not a war between two countries. This is a war between two worlds. The first and most important thing I need to establish in this episode is something that fundamentally changes how you should be analyzing this conflict and its market implications. Most people, most media coverage, most casual observers are framing this as a war between Iran and a United States and Israel alliance. And at the tactical level, at the level of missiles and airstrikes and military deployments, that framing is accurate. Those are the combatants. Those are the forces directly engaged. But at the strategic level, at the level of interests, alliances, resources, and long-term geopolitical positioning, this conflict is something far larger and far more consequential. What we are actually watching unfold is a confrontation between two emerging global blocs, two competing visions for how the world should be organized, who should lead it, and whose rules should govern it. And understanding those blocs, understanding their composition, their interests, their strategies, and their economic leverage, is the key to understanding everything that follows. The first bloc is what we can broadly call the Western Alliance. At its core, the United States, Israel, NATO members, particularly the major European powers, the United Kingdom, and frontline states in Eastern Europe, and a broader coalition of countries that have historically aligned with American-led international institutions, American security guarantees, and the American-dominated global financial system. The interests of this bloc in this conflict are multiple and layered. The United States wants to prevent Iran from acquiring nuclear weapons, a goal that has been explicit American policy for decades. Israel, existentially threatened by a nuclear Iran, wants to eliminate that threat permanently. NATO allies are watching closely because a Middle East energy shock affects their economies directly, and because a weakened Western deterrence posture anywhere in the world encourages adversaries everywhere else in the world. The second bloc is more diffuse, more complex, and frankly more interesting to analyze for our purposes, because it does not have formal treaties or declared alliances in the way NATO does. Its cohesion comes not from shared values or institutions, but from shared opposition to American global dominance. At its core, Iran, the country directly at war. Russia, which has been moving steadily closer to Iran through military cooperation agreements, energy deals, and shared anti-Western strategic interests. China, which has not taken an explicit military side in this conflict, but whose strategic calculations are deeply intertwined with its interests, which is the largest importer of Middle Eastern oil on Earth, and which has been building economic and strategic relationships with Iran for years through its Belt and Road Initiative. And North Korea, which has been providing military technology, particularly drone technology and certain weapons systems, to Iran in what analysts describe as a mutually beneficial arrangement. Now, why does this block structure matter so profoundly for investors? It matters because it tells you that this conflict is not going to be resolved the way a simple bilateral military dispute between two countries might be resolved. There is no straightforward negotiating table at which Iran and the United States can sit down, agree on terms, and end the fighting. Because the interests behind each side extend far beyond the immediate parties. Russia has a strategic interest in this conflict continuing. Every day that oil stays above $100, Russia makes more money. Every day that the United States is militarily and politically consumed by the Middle East, Russia has more freedom of action in its own neighborhood. Russia is not a neutral bystander. Russia is a beneficiary, a passive but deeply interested beneficiary of continued conflict. China's interests are more complex and frankly more important for global markets. China is the world's largest importer of oil. Disruption to Middle Eastern oil supply hurts China's economy directly. But China also benefits strategically from American military overextension. A United States tied down in a prolonged Middle Eastern conflict is a United States with less bandwidth to focus on the Asia-Pacific, which is where China sees its most important strategic competition playing out. So China is simultaneously hurt by the energy disruption and benefited by the geopolitical distraction. Its policy response has been careful, calibrated, and strategic. It has not condemned the American strikes. It has not endorsed Iran. It has called for dialogue and restraint, the diplomatic language of a power that wants to be seen as responsible while keeping all its options open. North Korea's role is smaller in scale, but symbolically significant. North Korean drone technology and weapons components have reportedly been flowing to Iran for years, via Russia as an intermediary. This is part of a broader pattern of what analysts call the axis of the sanctioned countries that have been cut off from Western financial systems and Western technology finding ways to cooperate with each other to fill the gaps. When Iran launches a drone, there may be Korean technology inside it. When Russia fires a missile, there may be Iranian components in the targeting system. The lines between these actors are blurring in ways that have profound strategic implications. For investors, the cause and effect of this bloc dynamic is significant and specific. Because if this is a bloc confrontation rather than a bilateral conflict, the economic tools being deployed are not just military. They are financial, they are technological, they are trade-based, and they are energy-based. And they will play out over years, not weeks. The Western Bloc controls the global financial system, the dollar-based payment networks, the SWIFT interbank messaging system, the international bond markets, the technology supply chains. When it imposes sanctions, it can cut countries off from global commerce in ways that are deeply painful. The Eastern Bloc controls a significant share of global energy supply, global rare earth mineral production, and an increasingly capable military-industrial complex. When it chooses to disrupt energy markets, it can create inflationary pain in Western economies that is difficult to counter quickly. This is the real war, not the missiles over Tehran. The real war is an economic and strategic competition between two blocs for dominance over the systems that run the global economy. And the 2026 Iran conflict is simply the most visible and explosive battleground of that larger competition at this particular moment in history. Markets will eventually understand this. The investors who understand it first will be positioned for the decade-long implications rather than just the next week's price move. Part 2 of this episode, the Strait of Hormuz. Why 33 kilometers of water is the most powerful economic weapon on Earth. We talked about the Strait of Hormuz in Part 1. But I want to go deeper today, because the Strait of Hormuz is not just a geography story. It is a strategy story. And the strategy behind Iran's use or potential use of that waterway as a weapon is something that every investor needs to truly understand at a granular level. Let me paint you a picture. Every single day, under normal conditions, somewhere between 17 and 21 million barrels of oil transit through the Strait of Hormuz. Most of that oil is going to Asia, to China, Japan, South Korea, and India, which collectively import an enormous share of their total energy needs from Gulf producers. Some goes to Europe, some goes to other destinations. That 20% of global daily oil supply is not just oil. It is the lubricant of the global industrial economy. Without it, factories slow. Without it, power plants struggle. Without it, transportation becomes expensive and unreliable. Without it, the just-in-time supply chains that modern commerce depends on begin breaking down. Iran knows this. Iran has known this for decades. And Iran has spent decades building a military doctrine, a specific, deliberate, extensively resourced military doctrine, around the ability to deny the use of that waterway to its enemies and to the broader global economy if it chooses to do so. The Iranian military has fast attack boats designed to swarm and overwhelm larger naval vessels. It has anti-ship missiles positioned along the northern coastline of the strait, capable of striking tankers from land. It has underwater mines, thousands of them, that it could seed throughout the strait in a matter of hours, making navigation extraordinarily dangerous and potentially impossible without extensive minesweeping operations that would take weeks. It has submarine capabilities, it has drone swarms, and it has decades of practiced operational planning for exactly this scenario. This is Iran's ultimate deterrent. This is its nuclear option in the non-nuclear sense. The ability to say, if you strike us hard enough, we will take the global oil market down with us. Now, here is where the cause and effect becomes especially important for markets. Iran does not need to fully close the Strait of Hormuz to cause massive economic disruption. It does not need to sink 20 tankers. It does not need to lay a minefield across the entire channel. All it needs to do is make shipping companies believe that the risk of transiting is too high. All it needs to do is attack a handful of high-profile vessels, or even threaten to. And the rational response of commercial shipping operators, who are not in the business of sending their crews and their multi-hundred-million-dollar assets into a live war zone without adequate protection, is to stop going through. This is called a deterrence effect, and it is exactly what has been happening. Tanker traffic has been falling not because every tanker has been attacked, but because the probability of attack, the insurance cost, the crew risk, the routing uncertainty, has become economically and practically unmanageable for normal commercial operators. The maritime insurance market, which is one of the most sophisticated and well-informed markets in the world, has been sending signals about this for weeks. War risk premiums for Hormuz transits have spiked to levels that fundamentally change the economics of shipping oil through that route. Some insurance providers have simply withdrawn coverage entirely. What happens when you cannot insure a route? You do not use it. Even if no bomb falls on your ship, you do not use it. And when you do not use it, the oil does not flow. And when the oil does not flow, prices rise. Now let me give you the specific numbers that analysts are modeling, because this is where the investment implications become very concrete. Under the current scenario, contested but not fully closed strait, elevated risk, reduced traffic, oil has settled into the $100 to $126 range that we discussed in Part 1. If the situation escalates to serious and sustained tanker attacks, not just occasional threats but regular actual strikes on commercial vessels, shipping companies will not just reduce traffic. They will stop entirely. At that point, the supply shock becomes acute. We are talking about potentially 10 to 15 million barrels per day removed from global markets almost instantaneously. In that scenario, the price models that credible energy analysts are running produce numbers in the $130 to $160 range for Brent crude. Some more extreme models go higher. And this is the scenario that central bankers genuinely fear. If a combination of Hormuz disruption, Saudi production uncertainty, and broad Gulf instability removes 17 to 20 million barrels per day from global supply, we are in genuinely uncharted territory. Prices could reach $180 or even $200 per barrel. We have never been there before in the modern era. We have no real historical roadmap for what that does to the global economy, but the models are not encouraging. What we do know from history is that every serious oil price spike of the last 50 years, 1973, 1979, 1990, 2008, was followed by recession. Every single one. The mechanism is consistent and well documented. Energy shock raises costs across the economy, reduces real consumer purchasing power, slows economic activity, eventually tips growth into contraction. The difference in 2026 is that we are entering this shock with global interest rates already at elevated levels, the legacy of the post-pandemic inflation fight, which means the economy has less capacity to absorb the additional stress of an energy shock before tipping into recession. This is why the Strait of Hormuz is not just a geography story. It is the central variable in every serious macroeconomic model of this crisis. And tracking its status daily through satellite data, through shipping traffic analytics, through insurance rate movements, is the single most important thing an investor can do to stay ahead of the major market moves in this environment. Part 3 of this episode, The War You Cannot See. Cyber warfare and the invisible battlefield. There is a dimension of this conflict that almost no financial media is covering adequately. And the irony is that in some ways, it may be the most immediately dangerous dimension for financial markets. I am talking about cyber warfare. Modern wars are not fought only with missiles and aircraft and naval vessels. They are fought simultaneously in digital space. And the 2026 Iran conflict is no exception. In fact, it may be the most intensive cyber warfare operation ever conducted alongside a conventional military conflict. Let me explain why this matters so acutely for markets and for investors. Iran has spent years, arguably decades, building one of the most sophisticated and aggressive state-sponsored cyber warfare programs in the world. This is not speculation. This is documented fact, confirmed by intelligence agencies and cybersecurity firms across multiple countries. Iranian cyber operators, working through groups that the intelligence community has given names like APT-33 and Charming Kitten and others, have developed deep capabilities in industrial sabotage, critical infrastructure attacks, financial system intrusions, and information operations. The cause and effect here is direct and serious. Think about what the most disruptive possible cyber targets in this conflict environment would be. The first and most obvious is oil infrastructure. Saudi Aramco, the Saudi state oil company and one of the most important energy companies on Earth, was famously hit by a major cyber attack in 2012 that destroyed tens of thousands of computers. That attack, widely attributed to Iranian cyber operators, was a warning shot. In the current conflict environment, a serious cyber attack on Gulf oil infrastructure, on the control systems that manage production, on the pipelines, on the export terminals, could disrupt oil production far more quickly and far more severely than any military strike. You do not need to bomb an oil terminal to stop oil flowing from it. You can potentially achieve the same result by penetrating the industrial control systems that manage the terminal's operations and forcing them to shut down or malfunction. Modern oil infrastructure is deeply computerized. That computerization makes it more efficient. It also makes it potentially more vulnerable. The second category of cyber targets is even more alarming from a market perspective: financial infrastructure. Global financial markets run on digital systems. Stock exchanges, banking networks, payment clearing systems, international wire transfer mechanisms. All of these are digital, All of these are networked, and all of these are potential targets for state-sponsored cyber actors who want to create maximum economic disruption. Consider what a serious, sustained cyber attack on a major stock exchange would mean. Not just a brief outage, those happen occasionally and are managed. A sustained attack that prevents trading for days. A successful attack on a major bank's payment processing systems. A penetration of the SWIFT interbank messaging network that is the backbone of international wire transfers. Any of these scenarios would create immediate, severe market panic. Not because the underlying economic fundamentals had changed, but because the infrastructure that allows markets to function had been compromised. The cause and effect chain runs like this. Cyber attack disrupts financial infrastructure. Market participants cannot execute trades or transfers, uncertainty about system integrity spikes, liquidity dries up as participants pull back, and the panic that follows can easily exceed the actual damage of the attack itself. History suggests this is not a hypothetical concern. The 2010 Stuxnet attack, widely attributed to the United States and Israel, successfully sabotaged Iranian nuclear centrifuges using malicious code. It demonstrated that cyber weapons can cause physical damage to industrial systems. Since then, the sophistication and destructiveness of state-level cyber weapons has grown enormously. The third category of cyber vulnerability that investors should be thinking about is logistics and shipping systems. Global shipping, the movement of tens of thousands of cargo vessels across the world's oceans, is coordinated through digital systems. Port management systems, navigation and routing software, cargo tracking and documentation platforms, insurance and customs clearance networks. If any of these are disrupted at scale, the physical movement of goods can be slowed or halted even if no bomb falls anywhere near the ships themselves. In a conflict where physical shipping routes through the Middle East are already under pressure, a simultaneous cyber disruption of the digital systems that coordinate alternative shipping would compound the physical disruption and could tip an already stressed supply chain situation into genuine gridlock. For investors, the practical implications of the cyber warfare dimension are significant. Cybersecurity companies become strategically important in this environment. The demand for advanced threat detection, critical infrastructure protection, network security monitoring, and incident response services is surging. Governments and private sector companies alike are scrambling to assess and harden their cyber defenses. This creates a spending wave that benefits the leaders in enterprise cybersecurity. But more broadly, the cyber dimension adds a layer of uncertainty to an already uncertain market environment. Because cyber events are unpredictable in their timing and difficult to attribute in real time. Unlike a missile strike, which is immediately visible and immediately attributable, a cyber attack may not be discovered for hours or days. And when it is discovered, the full scope of the damage may not be clear for longer still. This unpredictability is itself a source of market risk. Markets manage known risks through pricing. Unknown risks, risks that cannot be quantified, that can materialize suddenly and without warning, create the kind of deep uncertainty that causes investors to demand a higher risk premium for holding all assets. And that risk premium compression is bearish across the board. Part 4 of this episode, the 3 oil scenarios every investor must have mapped out. Let me now do something very concrete and very practical. Because all of the geopolitical analysis in the world is only useful if it translates into actionable frameworks for protecting and growing your capital. I want to walk you through 3 specific oil market scenarios that professional investors and institutional strategists are modeling right now. 3 scenarios that have specific price ranges, specific trigger conditions, and specific portfolio implications. And I want you to understand each one deeply enough that when you see the relevant signals developing in the market, you can recognize them and respond appropriately. Scenario 1 is what analysts are calling the controlled conflict scenario. This is the base case, the most likely outcome if conditions do not dramatically worsen from where they are today. In this scenario, the military conflict continues. Missile exchanges, proxy attacks, sporadic disruptions to Gulf shipping, these remain the ongoing reality. But the Strait of Hormuz, while contested and dangerous, remains functionally open. Major tankers continue transiting, albeit with reduced frequency, higher insurance costs, and significant delays. Production from the major Gulf producers, Saudi Arabia, Kuwait, the Emirates, is disrupted but not eliminated. Under these conditions, oil finds a range. Not the $70 we were at before the conflict, but not the catastrophic $180 of a worst-case scenario either. In the controlled conflict scenario, analysts are modeling Brent crude in the $90 to $110 range. What does this mean for markets? It means persistent elevated inflation. An oil price of $90 to $110 feeds through to gasoline, transportation, and manufacturing costs in ways that keep inflation above central bank targets. Central banks that were planning rate cuts will delay those cuts. Some may not cut at all in 2026. It means persistent equity market volatility. Not a crash, but not a sustained rally either. Markets will remain range-bound, with sharp moves in both directions as news flow shifts. Earnings estimates will be revised lower as companies absorb higher energy costs. Valuations that seemed reasonable at $70 oil become stretched at $100 oil. It means defense stocks and energy stocks continue to significantly outperform. The companies that produce oil and the companies that make weapons are both operating in an environment that is fundamentally favorable to their businesses. That will be reflected in their stock prices. The signal to watch for that confirms the controlled conflict scenario is stabilizing. Tanker traffic data through the strait that shows a floor forming, not increasing, but no longer declining sharply. Insurance premium levels that are high but stable rather than continuing to rise. Military communications from both sides that focus on current operations rather than announcing new escalatory measures. Scenario 2 is the major supply shock scenario. This is the intermediate case, not the most likely but not the tail risk either. A meaningful probability that every investor should be positioned to navigate. The trigger for this scenario is a material escalation in attacks on commercial shipping in or near the Strait of Hormuz. Not occasional attacks or threats, but sustained, regular strikes on tankers that make commercial transit effectively impossible without naval escort. In this scenario, the major shipping companies exit the route. Tanker traffic collapses. The effective supply disruption from the Gulf region rises sharply above current levels. Oil in this scenario reaches $130 to $160 per barrel. At those levels, the economic damage becomes severe and broad-based. Inflation makes a significant comeback. Not the gradual creep of the controlled conflict scenario, but a sharp, rapid, across-the-board spike in consumer prices. Central banks face an impossible choice: raise rates to fight inflation and risk tipping already stressed economies into recession, or hold rates and allow inflation to erode real purchasing power and financial stability. Global equity markets sell off meaningfully. Not every sector equally. Defense and energy continue to perform, but the broad market indices face double-digit percentage declines as earnings estimates are cut, recession fears rise, and risk appetite collapses. Emerging markets face particular pain. Countries that import significant amounts of oil and have borrowed heavily in United States dollars face a triple threat. Higher import costs, a strengthening dollar that makes their debt more expensive to service, and capital outflows as global investors retreat to safer assets. This can create genuine financial crises in vulnerable emerging economies. The signal to watch for this scenario developing: any confirmed attack on a supertanker, the very large crude carriers that move the largest volumes of oil, will be immediately significant. Supertanker attacks signal a qualitative escalation in willingness to disrupt global trade. Insurance market responses will follow within hours. Shipping company routing decisions will follow within days. An oil price response will be immediate and sharp. Scenario 3 is the full regional war scenario. This is the tail risk, the event that has a lower probability of occurring but a catastrophic impact if it does. Every serious investor needs to understand this scenario, even if they believe the probability is relatively low, because the asymmetry of the outcome makes it important to have some defensive positioning against it. The trigger for this scenario is the direct military involvement of major Gulf oil producers, specifically Saudi Arabia, in the conflict. Whether through Iranian attacks on Saudi infrastructure, through political decisions by Saudi leadership to enter the conflict, or through the conflict expanding to the point where Saudi Arabia's own security is directly and imminently threatened. Saudi Arabia produces roughly 9 to 10 million barrels of oil per day. The United Arab Emirates produces 3 to 4 million. Together, that is roughly 13 to 14 million barrels of daily production, on top of the already disrupted Iranian, Iraqi, and Kuwaiti supply that would be at risk. At that level of supply disruption, oil prices reach $180 to $200 per barrel by virtually every model. And at those levels, the global economy does not just slow. It stops. Recession becomes virtually certain. Not a mild recession, a severe, synchronized global recession affecting every major economy simultaneously. Stock markets in this scenario would face declines of 30 to 50% from peak levels. Corporate earnings would collapse, consumer spending would fall sharply, unemployment would rise, governments would attempt emergency fiscal stimulus, but the scale of the economic disruption would overwhelm normal policy responses. Central banks, caught between surging inflation from energy prices and collapsing growth from the economic shock, would face their worst nightmare, the stagflation trap we discussed in Part 1, but at a far more severe level than the controlled conflict scenario implies. This is not a scenario to panic about. It is a scenario to be prepared for. Having some portfolio allocation to assets that perform well in this environment, gold, defensive equities, commodities, energy producers, provides insurance against the tail risk even if it never materializes. Part 5 of this episode, the defense spending explosion. Why this changes everything for a decade, one of the most enduring market implications of this conflict, and one that extends far beyond the conflict's immediate duration, is the effect on global defense spending. And I want to spend real time on this because I think most investors are significantly underestimating both the scale and the duration of the defense spending cycle that this conflict has triggered. Let me start with the basics. Wars consume weapons. When weapons are consumed in large quantities, when missiles are fired, when drones are lost, when air defense interceptors are used, the stockpiles that militaries have built up over years of peacetime procurement get depleted rapidly. The conflict between the United States, Israel, and Iran has been consuming munitions at a rate that is extraordinary by historical standards. Modern precision weapons are extraordinarily effective. They are also extraordinarily expensive to produce and not easy to replace quickly. Production lines have capacity constraints. Supply chains for the specialized components, the sensors, the guidance systems, the propulsion components, have long lead times. The immediate implication is obvious. The companies that make these weapons are going to be producing at maximum capacity for years. Not months, years, because you do not rebuild depleted stockpiles in months. You rebuild them over the extended production cycles that govern defense manufacturing. But the less obvious and ultimately more important implication is what this conflict does to defense spending globally, not just in the countries directly involved. Every government in the world is watching what is happening in the Middle East and conducting the same mental calculation. If a conflict of this scale can erupt this suddenly, with this level of intensity, with this level of precision munitions consumption, are we adequately prepared? Do we have enough missiles? Do we have adequate air defenses? Is our drone capability sufficient? Is our cyber warfare capability strong enough? The honest answer, for the vast majority of countries, is no. NATO members in Europe had already begun increasing defense spending following the Russia-Ukraine conflict. But the Middle East crisis is accelerating that trend dramatically. Countries that had made commitments to reach 2% of GDP in defense spending, and were still falling short, are now facing political pressure to get to 3%. Some are discussing 4%. Asian nations, Japan, South Korea, Australia, Taiwan, the Philippines, are watching the United States military strain to manage multiple simultaneous commitments and concluding that they cannot rely solely on American security guarantees. They need to build their own capabilities. Japan, in particular, historically constrained by constitutional limits on military spending, has been undergoing a profound strategic transformation in recent years. This crisis is accelerating that transformation. Emerging market nations across Africa, Southeast Asia, and Latin America, watching great power competition intensify, are recalculating their own security environments and their own defense needs. The cumulative effect of all this reassessment, all this recalibration, all this increased political commitment to defense spending globally is a defense spending supercycle. Not a single year of elevated procurement. A multi-year, multi-decade shift in the baseline level of defense expenditure across the global economy. Now let us talk about the specific categories within defense that are most important for this conflict and this spending cycle. The first is missile systems, both offensive precision-guided munitions and defensive interceptor systems. The conflict has demonstrated with brutal clarity that in a modern war between technologically sophisticated adversaries, missile and drone exchanges happen at a pace and scale that rapidly depletes even the largest stockpiles. Every country with adversaries, which is most countries, now wants more missiles, more interceptors, larger stockpiles, faster production. The demand is enormous. The second category is drone warfare, both offensive attack drones and defensive counter-drone systems. Drones have transformed this conflict in ways that are reshaping military thinking globally. They are cheap relative to conventional weapons. They are difficult to intercept. They can be deployed in swarms. They can be operated at significant distances. They can conduct surveillance, targeting, and attack missions. Every military in the world is watching the drone combat in this conflict and drawing the same conclusion. We need more, we need better, and we need both the offensive and defensive sides of this equation. The companies that make advanced drone systems, drone swarm management software, and counter-drone technology are entering a period of extraordinary demand growth. The third category is cybersecurity and military technology. We talked about cyber warfare earlier in this episode. The military dimension of cybersecurity, offensive cyber capabilities, defensive hardening of military command and control systems, electronic warfare, is a high-priority spending area for every serious military in the world. The fourth category is military artificial intelligence. The use of artificial intelligence in targeting, surveillance, logistics, and decision support is accelerating in every major military. This conflict is generating real-world data and real-world pressure that will accelerate military AI development and procurement. For investors, the defense sector is not a trade that lasts a few weeks. It is a structural, multi-year theme that has just received an enormous catalyst in the form of this conflict. The companies positioned in the right subsectors, missiles, drones, cyber, military AI, are entering a period that could prove to be one of the most favorable revenue and earnings environments in the history of the defense industry. Part 6 of this episode, China's master chess game. The most important thing nobody is talking about of all the geopolitical dynamics swirling around this conflict, the one that I believe is most consequential for long-term investors, and the one that receives the least adequate coverage in most financial media, is China's strategic position and response. Let me lay out the complexity of China's situation here, because it is genuinely complex. And the complexity itself tells you something important about how this conflict will play out and what its long-term implications are. China is the world's largest importer of oil. Full stop. China's industrial economy, its transportation infrastructure, its military capability, all of it runs on enormous quantities of energy, a significant portion of which comes from the Middle East. Saudi Arabia is China's largest single source of imported oil. The UAE, Iraq, and Kuwait are all major suppliers. When Middle Eastern oil supply is disrupted, China is hurt. Directly, economically, immediately. Higher oil prices increase China's import costs, weaken its currency, pressure its current account balance and add inflationary pressure to an economy that is already managing significant internal stresses. In that sense, China and the United States, bitter geopolitical rivals, share a common interest in stable Middle Eastern oil supply. But here is where it gets complicated. China also has a deep strategic interest in American overextension. Every military deployment the United States makes to the Middle East is a deployment it cannot make simultaneously to the Taiwan Strait or the South China Sea. Every $1 billion the American military spends on Middle Eastern operations is $1 billion not available for the systems and capabilities that would be relevant to a potential conflict with China. Every political and diplomatic capital the American administration spends managing this crisis is capital not available for the diplomatic coalition building that is central to American strategy in Asia. China is watching this conflict with the cold, patient calculation of a great power that takes a long view. It is not celebrating Iranian missile strikes or cheering American military setbacks, but it is observing carefully. It is noting what capabilities were effective and what were not. It is watching how American allies respond under pressure. It is assessing the credibility of American extended deterrence commitments. And it is drawing conclusions that will inform its own strategic decisions for years to come. Now here is the specific strategic play that China is making, quietly, methodically, and largely below the radar of Western financial media. China is using this conflict as an accelerant for what has been its central strategic economic goal for the last decade, reducing its dependence on Western-controlled infrastructure. Western-controlled infrastructure includes the United States dollar as the dominant currency of international oil trade. It includes the SWIFT banking system that processes international financial transactions. It includes the sea lanes and supply routes that are secured by American naval power. And it includes the technology supply chains that run through American-dominated companies and systems. China has been methodically building alternatives to each of these for years. The Belt and Road Initiative, China's enormous infrastructure investment program across Asia, Africa, and Europe, is fundamentally about building alternative trade routes that do not depend on American-secured sea lanes. The Petro-yuan, China's attempt to establish the yuan as a currency for international oil transactions, is fundamentally about reducing dollar dependence in energy trade. China's development of its own alternative to SWIFT is fundamentally about reducing financial system vulnerability. This conflict accelerates all of those efforts, because every week that the Middle East is unstable and American-secured shipping routes are disrupted is a week that makes the case for Chinese alternative infrastructure more compelling to every country that depends on those routes. Think about what happens to China's relationships with Middle Eastern oil producers when this is over. Saudi Arabia, which has been a cornerstone of the American-secured global oil order for 50 years, is watching a conflict unfold in which the United States is a combatant party rather than a stabilizing force. The Gulf states are being asked to endure missile attacks, shipping disruptions, and economic uncertainty as a consequence of American and Israeli military choices. China, meanwhile, is offering something different. It is offering investment. It is offering trade. It is offering diplomatic engagement without military entanglement. The 2023 China-brokered normalization agreement between Saudi Arabia and Iran, which shocked the world at the time, was a preview of China's diplomatic strategy in the region. China wants to be the country that brings stability, that facilitates dialogue, that enables economic relationships to continue regardless of American geopolitical choices. If China succeeds in deepening its economic relationships with Gulf producers during and after this crisis, if it secures longer-term oil supply agreements denominated in yuan, if it builds infrastructure connecting the Gulf to Chinese markets, the long-term implications for dollar dominance in oil trade, and therefore for the dollar's broader reserve currency status, are significant. This is not a near-term market-moving event, but it is a structural trend that will affect global financial markets over a 10 to 20-year horizon, in ways that attentive investors should be positioning for. For investors, the China dynamic in this conflict tells you several things. It tells you that the Chinese yuan's role in global finance is likely to grow, slowly, inconsistently, with many setbacks, but directionally upward. This has implications for currency markets, for dollar-denominated asset valuations, and for the pricing of commodities that China buys in large quantities. It tells you that Chinese companies building alternative infrastructure, alternative payment systems, alternative shipping networks, alternative energy supply relationships, are potentially very significant beneficiaries of the long-term trend this conflict is accelerating. And it tells you that the geopolitical risk premium in global markets, the extra cost that investors demand to hold assets that depend on geopolitical stability, is probably going to be a permanent feature of the investment landscape rather than a temporary disturbance. The world China and the United States are building is a more divided world, a more fragmented world, a world in which the smooth global economic integration of the 1990s and 2000s is not coming back. Part 7 of this episode, The Hidden Economic War, Weapons You Never See on the News. We have talked about missiles. We have talked about oil. We have talked about cyber attacks. But there is another category of warfare being conducted alongside and around the military conflict, a category that is just as powerful, just as destructive of economic value, and just as relevant for investors. And it receives almost no coverage. I am talking about the economic weapons, the sanctions, the asset freezes, the trade restrictions, the currency manipulation, the capital flow warfare that great powers deploy against each other in contexts like this one. Economic warfare has become as sophisticated and as potent as military warfare. And in some ways, it is more dangerous for markets, because it moves more slowly, its effects are harder to trace, and its unintended consequences are enormous. Let me walk you through what is actually happening in the economic warfare dimension of this conflict. The United States has already imposed new and expanded sanctions packages on Iran in the wake of the military strikes. This is standard operating procedure. When military action is taken, economic pressure is tightened simultaneously. The goal is to compound the military pressure with financial strangulation, cutting Iran's access to the international dollar system, freezing assets held in jurisdictions that cooperate with American sanctions, restricting the ability of companies anywhere in the world to do business with Iranian entities under penalty of losing their own access to the American financial system. The cause and effect here is direct, but has unintended consequences that matter for investors. When the United States imposes aggressive sanctions on a major energy producer, it does not just hurt that producer. It creates ripple effects throughout the global economy. Companies in Europe, Asia, and elsewhere that had legitimate business relationships with Iranian entities, in energy, in trade, in finance, are forced to choose between their Iranian relationships and their access to the American financial system. Most choose to sever their Iranian ties. This accelerates Iran's economic isolation. But it also creates friction, uncertainty, and cost for every company navigating the compliance requirements. Sanctions also have a perverse effect on energy supply. They restrict the flow of Iranian oil onto global markets through official channels. But they do not stop the oil from being produced or sold. They just force it through gray markets, through intermediaries, through Chinese buyers who are willing to pay below market prices to absorb sanctioned barrels in exchange for the discount. This means sanctions on Iranian oil do not fully remove supply from the market, but they do distort it, creating inefficiencies and uncertainties that add to overall market volatility. On the other side, Iran and its allies have their own economic weapons. Iran can manipulate its own oil export decisions, reducing exports to strengthen the global price or flooding certain markets with discounted supply to build political alliances. Russia can choose to direct its own energy exports in ways that provide maximum geopolitical benefit. China can use its enormous purchasing power and financial resources to support allied economies or to create economic pressure on adversaries. The most powerful of these counterweapons is what analysts call the weaponization of commodity supply. We have already seen Russia use natural gas supply as a geopolitical weapon in its conflict with Europe. The lesson has not been lost on other commodity-rich nations. In a world where critical materials, oil, gas, rare earth minerals, lithium, cobalt, are concentrated in the hands of a relatively small number of producers, controlling access to those materials is geopolitical power. For investors, the economic warfare dimension creates several specific risks that need to be managed. Currency risk. When sanctions are imposed on major economies or their trading partners, exchange rates move sharply and unpredictably. Emerging market currencies that are linked to sanctions targets are particularly vulnerable. Companies with significant revenue exposure to affected regions can see their earnings decimated by currency moves even if their underlying business is performing well. Counterparty risk. In periods of intense economic warfare, the reliability of financial counterparties, the institutions that sit on the other side of trades, that hold assets, that facilitate transactions, becomes more uncertain. Due diligence on counterparty exposure to sanctioned entities or to financial systems that are under attack becomes critical. Supply chain disruption risk. The economic warfare creates sudden, unpredictable disruptions to supply chains as companies scramble to sever sanctioned relationships and find compliant alternatives. Companies with complex global supply chains, which is most large industrial and technology companies, face elevated risk of sudden supply disruptions. And perhaps most importantly, the risk of financial system fragmentation. If this conflict deepens the division between the dollar-based Western financial system and the emerging alternatives that Russia, China, Iran, and their allies are building, global capital markets become more complex, more fragmented, and more expensive to navigate. Transaction costs rise, currency risk multiplies. The efficiency gains of a truly globalized financial system erode. This is a slow-moving risk, but it is directionally very important, and it is already happening. Part 8 of this episode, Why Markets React This Way. The psychology behind the volatility. I want to take a step back here and talk about something that I think is deeply underappreciated by most investors, even experienced ones. I want to talk about why markets behave the way they do in geopolitical crises like this one. Because if you understand the psychology, you understand the pattern. And if you understand the pattern, you can use it rather than be victimized by it. Markets are, at their core, a collective mechanism for processing and pricing uncertainty. When uncertainty is low, when the economic environment is stable and predictable, when corporate earnings are growing steadily, when interest rates are stable, when geopolitical risks seem distant, markets price assets relatively generously. They give companies the benefit of the doubt. They assign high valuations to earnings because the probability of those earnings materializing seems high. When uncertainty spikes, and a sudden military conflict between major powers is one of the most acute forms of uncertainty the market can face, everything runs in reverse. Markets do not just reprice the specific companies directly affected by the conflict. They reprice all assets, because when the world becomes suddenly less predictable, the value of certainty and safety increases relative to the value of growth and risk. This is why you saw the broad market sell-off in the immediate aftermath of Operation Lion's Roar. It was not that every company in the S&P 500 was directly harmed by military strikes on Iran. Most of them have no direct Iranian exposure. But in a world that just became significantly more uncertain and significantly more dangerous, the risk premium required to hold any risky asset went up. And when the risk premium goes up, valuations go down. Now here is the pattern that history reveals, and it is the most practically important thing I am going to say in this entire section. The initial reaction to major geopolitical events is almost always to overprice the uncertainty. Markets overestimate the probability of the worst-case scenario. Panic is not a precision instrument. Fear is not a precise calculator. When people are scared, they sell. And they often sell things they should not sell, at prices they would never accept in calmer conditions. The Gulf War in 1990. the September 11th attacks in 2001, the Iraq War in 2003, the beginning of the Russia-Ukraine conflict in 2022. In every one of these cases, the initial market response was sharp and fearful. And in every one of these cases, every single one, the market eventually recovered and moved higher. In some cases, significantly higher. This is not because wars are good for the economy. They are not. This is because markets ultimately price future cash flows of businesses, and businesses are remarkably adaptive and resilient over time. They find new supply chains when old ones are disrupted. They raise prices to protect margins. They cut costs when revenue comes under pressure. They innovate in response to new constraints and new realities. The investors who profited most from every one of those historical crisis moments were not the ones who panicked out. They were the ones who understood that the initial sell-off was almost certainly an overreaction, that the world's businesses would adapt, and that the time to buy quality assets was when everyone else was selling them in fear. And this is a critical but, you have to distinguish between a crisis that is genuinely temporary and one that represents a permanent structural change. Because sometimes the fear is correct. Sometimes the world has changed in ways that make pre-crisis valuations permanently wrong. In this conflict, the honest assessment is that both things are true. Some of the fear is overreaction. Some companies are being sold off far more aggressively than their actual exposure warrants. Those represent potential opportunities for patient, informed investors. But some of the structural change is real and permanent. The global energy order is shifting. Supply chains are being rewired. Defense spending is structurally elevated for years. Inflation is likely to be structurally higher than the 2010 decade average for an extended period. Investors who position as if the world of 2024 is coming back are making a mistake. The thing that separates great investors from good ones in an environment like this, is the ability to correctly distinguish between the temporary and the permanent. To know which stocks are being unfairly punished by panic and will recover, and which ones are in businesses that are genuinely less valuable in the new world than they were in the old one. Part 9 of this episode, The End of Globalization as We Knew IT, the biggest long-term risk. I have mentioned several times in this episode that the long-term risk here extends well beyond the immediate conflict. Let me now develop that idea fully, because it is the most important framework for thinking about investing in the world that this conflict is helping to create. The model of globalization that has dominated the world economy since roughly 1990, since the fall of the Berlin Wall, since China's entry into global trade networks, since the creation of the World Trade Organization, was built on a specific set of assumptions. It assumed that economic interdependence would reduce geopolitical conflict, that nations which traded heavily with each other would be unlikely to go to war because the economic cost would be too high. It assumed that comparative advantage, the idea that each country should specialize in what it does best and trade for everything else, would maximize global economic efficiency and prosperity. It assumed that global supply chains, the complex multi-country production networks that make modern goods, could be optimized for cost and efficiency without worrying too much about security and resilience. Those assumptions have been challenged repeatedly over the last decade. The Russia-Ukraine conflict demonstrated that major power conflict is possible even between economically integrated nations. The pandemic demonstrated that highly optimized, just-in-time supply chains are catastrophically fragile when they are disrupted. The technology competition between the United States and China demonstrated that national security concerns can override economic efficiency in technology supply chains. And the 2026 Iran conflict is delivering the latest and perhaps most powerful blow to the globalization model. By demonstrating that the energy supply chains that underpin the entire global economy can be disrupted by a regional conflict in a matter of weeks, it is forcing every government and every major corporation in the world to confront a question they have been avoiding. Is the efficiency of global optimization worth the fragility it creates? The answer they are coming to in government ministries, in corporate boardrooms, in military planning offices around the world is increasingly No. And the transition away from that answer, the process of building more resilient, more regional, more redundant supply chains and energy systems, is going to be one of the defining economic themes of the next decade. It is going to be expensive. It is going to be inflationary in the near term, because building redundancy into systems that were optimized for efficiency means accepting higher costs. And it is going to create enormous winners and losers. The winners will be the companies and the countries that are positioned to supply the new, more regionalized, more resilient world. Domestic manufacturers, regional logistics providers, energy diversification technologies, critical mineral producers that are located in geopolitically stable and allied nations, infrastructure companies building the physical systems of the new, more fragmented global order. The losers will be businesses whose entire value proposition was built on the assumptions of the old globalization model. Companies that built global supply chains optimized purely for cost, with no resilience. Companies that assumed energy would always be cheap and always be available. Companies that built business models around the smooth functioning of global financial networks that are now being fragmented. This is not a change that happens overnight. Globalization took decades to build. Its reorganization will take decades as well. But the direction is clear, and the 2026 Iran conflict has accelerated the timeline significantly. For investors, this big-picture framing suggests a set of long-term structural themes worth building exposure to. Energy independence and diversification infrastructure, domestic and allied nation manufacturing, critical mineral security, cybersecurity and digital resilience, and defense capability across the technology spectrum. These are not trading ideas for the next quarter. They are investment themes for the next decade. And the time to begin building exposure to them, thoughtfully, patiently, with appropriate position sizing, is in an environment where short-term panic is creating prices that long-term thinking can exploit. Part 10 of this episode, The Signal Dashboard. What smart money is watching every single day? Let me now give you the most practical section of this entire episode. A concrete, actionable signal dashboard. The specific things that professional investors and institutional money managers are watching in real time, and more importantly, what those signals mean when they change. I am going to organize this as a series of indicators, each one connected to a cause-and-effect chain that ultimately runs through to market prices. The first signal is oil price velocity, not just level. Every investor is watching oil prices, but the sophisticated ones are watching the rate of change, not just where oil is, but how fast it is moving and in which direction. A slow, gradual drift from $100 to $105 over 2 weeks is a very different market signal from a sudden spike from $100 to $115 in 48 hours. Rapid upward moves in oil signal that new information has entered the market, that something has happened or is feared to have happened that materially changes the supply outlook. Those moves demand investigation. Slow drift suggests sentiment is adjusting, but the fundamental picture has not dramatically changed. Rapid downward moves in oil signal either relief, diplomatic progress, shipping resuming, fear subsiding, or demand destruction. The economy is slowing so much that demand for energy is falling, which is itself an alarming signal. Learning to distinguish between oil falling on good news and oil falling on bad news is an important skill in this environment. The second signal is the diplomatic temperature gauge. Follow official statements and public communications from 4 key parties: the United States State Department, the Israeli government, Iranian leadership, and whatever neutral intermediaries, Qatar, Oman, Turkey, are known to have back-channel communications with Tehran. When the language from all sides is maximalist, when statements emphasize total victory, when conditions for negotiation are described as non-starters, when military operations are described as ongoing and intensifying, the diplomatic temperature is cold. No resolution is imminent. Market uncertainty persists. When the language begins shifting, when you start hearing words like conditions, dialogue, ceasefire, humanitarian corridor, or when neutral intermediaries begin making high-profile public statements about their own diplomatic roles, something is moving beneath the surface. These are the early signals that a diplomatic path may be opening. Markets will respond to these signals strongly and quickly. The third signal is the posture of the Federal Reserve and other major central banks. Central bank communications are the clearest indicator of how monetary policymakers are interpreting the economic situation. If the Federal Reserve begins communicating concern about renewed inflation from energy prices, if the language shifts from neutral to hawkish, if rate cut expectations are pushed further into the future, this is bearish for equities and for bonds. Higher rates for longer means lower valuations for growth assets and continued pressure on interest rate-sensitive sectors. If, on the other hand, central banks begin acknowledging that the economic slowdown risk is outweighing the inflation risk, if recessionary signals begin dominating their communications, the response will likely be to shift toward accommodative policy faster than the market expects. That pivot, when it comes, will be powerfully bullish for broad equities. The fourth signal is corporate earnings guidance. As companies report earnings and provide guidance for coming quarters, the guidance becomes a ground-level indicator of how the conflict is actually affecting the real economy versus how the market thinks it is affecting it. If airline companies are providing guidance that suggests they are managing the fuel cost spike better than feared, through hedging programs, fare increases, or capacity reductions, that is a positive signal. If energy companies are providing guidance that dramatically raises their production and revenue forecasts based on current oil prices, that confirms the bull case for the sector. If consumer companies are signaling that customers are pulling back spending faster and more dramatically than expected, that is an early warning signal for a demand-driven recession. Watch guidance more carefully than reported results. Reported results reflect the past. Guidance reflects the future that management sees from inside their businesses. The fifth signal is gold's behavior relative to equities. Under normal conditions, gold and equities have a relatively low correlation. When gold rises dramatically while equities also fall, it is a classic fear signal. Investors are selling risk assets and buying safety simultaneously. This pattern, when sustained, indicates deep, broad-based fear across the investment community. When gold begins to stabilize or fall while equities stabilize or rise, it is a signal that the peak fear moment may be passing, that the market is beginning to transition from panic to rational reevaluation. This transition is not always clean or clear, but the gold-equity relationship is one of the most reliable fear barometers available. The sixth signal is satellite data and open-source intelligence on tanker traffic. This may sound exotic, but it is increasingly accessible and increasingly watched by professional investors. Multiple companies provide satellite-based tracking of maritime traffic, including oil tankers. This data allows real-time monitoring of tanker movements through the Strait of Hormuz, through the Red Sea, and along alternative routes around Africa. When tanker traffic through the strait drops sharply, as measured by vessel counts, by cargo capacity transiting, or by the types of vessels present, the supply disruption is real and measurable, not just feared. When tanker traffic stabilizes or begins recovering, it is a direct signal that the physical oil supply situation may be improving. This kind of data moves before official government announcements. It moves before OPEC statements. It moves before formal diplomatic announcements. The investors and traders who track it have a genuine informational edge. Part 11 of this episode, the most important question: how long does the uncertainty last? Throughout this entire episode, there is one question that underlies all of the analysis, all of the scenarios, all of the signal watching. It is the question that ultimately determines how damaging this crisis will be for the global economy and how significant the market disruption will be for investors. The question is not who wins the war. Military outcomes in the context of this conflict are almost secondary to the broader geopolitical contest. The United States and Israel clearly have overwhelming military superiority over Iran in a direct conventional confrontation. That was never in serious doubt. The strikes of Operation Lion's Roar demonstrated it dramatically. But winning a military engagement, and winning a geopolitical competition are very different things. The history of American military action in the Middle East over the last 30 years is a history of winning engagements decisively and then struggling with the aftermath. The instability, the power vacuums, the proxy conflicts, the diplomatic consequences for years or decades. The real question, the question that financial markets are trying to price every day, is how long the uncertainty persists. How long before there is clarity about the conflict's scope and duration? How long before the Strait of Hormuz returns to something approaching normal operation? How long before the oil price spike either recedes into a new, elevated but stable range, or escalates into the catastrophic scenarios? How long before investors can look at a corporate earnings estimate and have reasonable confidence that the economic environment assumed in that estimate will actually materialize? Because markets do not just respond to bad news, they respond to uncertainty. And sustained uncertainty, the kind that prevents any confident forecast of the future, is the most toxic condition for investment returns. In the short term, the next few weeks, uncertainty is at its maximum. The conflict is new, the scope is still being determined, the escalation dynamics are not yet clear, the diplomatic possibilities are not yet apparent. This is when volatility is highest, and when the temptation to make dramatic portfolio changes based on daily news flow is strongest. It is also the period when the worst investment decisions are typically made. In the medium term, 3 to 12 months out, some of the uncertainty will begin resolving. One of the three scenarios we discussed earlier will be clearly asserting itself. Either the conflict is stabilizing at a manageable level, or it is escalating toward regional war, or diplomatic efforts are beginning to bear fruit. As clarity emerges, volatility will gradually subside. Rational analysis will reassert itself over fear. In the long term, beyond 12 months, the conflict's structural consequences will be the dominant reality. The world that this conflict has begun reshaping, more fragmented, more focused on energy security, more oriented toward defense, more inflationary, will be the investment environment that investors must navigate for years. The investors who will look back on this period with satisfaction will be the ones who did not panic out of good long-term holdings during the short-term volatility, who added selectively to sectors with genuine structural tailwinds, defense, energy, cybersecurity, energy independence, who maintained enough liquidity to be opportunistic, and who understood that this period of maximum uncertainty would eventually be followed by a period of greater clarity, a period in which the positions they built during the fear would begin delivering results. Part 12 of this episode, the final framework, investing in a world that has changed. Let me bring this all together now, because we have covered an enormous amount of ground in this episode. The block dynamics, the Strait of Hormuz as a strategic weapon, the cyber warfare dimension, the three oil scenarios, the defense spending supercycle, China's long game, the economic warfare tools, the psychology of market panic, the end of globalization as we knew it, the signal dashboard, and the fundamental question of uncertainty duration. What does all of this add up to? What is the framework that ties it all together? Here it is. The world that investors are operating in today, the world of March 2026, is categorically different from the world of even 12 months ago. Not just in the obvious sense that there is a war happening, but in the deeper sense that this conflict has revealed and accelerated structural changes that were already underway. The architecture of global trade, global energy, and global finance is being redesigned. Not demolished, redesigned. The pieces are the same. The nations, the companies, the technologies, the resources. But the relationships between those pieces, who trusts whom, who trades with whom, who secures whose energy supply, whose financial system is used to denominate what transactions, are all in flux in ways they have not been since the end of the Cold War. Investing in a world undergoing this kind of structural change requires a different mindset than investing in a stable, globalized, low geopolitical risk world. It requires a higher weight on geopolitical analysis relative to purely economic analysis. It requires sensitivity to supply chain resilience rather than just efficiency. It requires attention to national security considerations in technology and energy that were previously treated as separate from financial analysis. And it requires a longer time horizon because structural changes play out over years, not quarters. The specific positions that make sense in this environment: defense, energy, cybersecurity, domestic manufacturing, energy independence technologies, gold as insurance, are not new ideas. They are ideas that flow directly and logically from the structural analysis. They are ideas backed by both fundamental economics and by the historical pattern of how markets and economies behave in periods of geopolitical realignment. But position sizing matters, diversification matters, liquidity matters. No analyst, no model, no amount of geopolitical expertise can predict with certainty how this conflict will develop over the coming weeks and months. The correct response to that uncertainty is not paralysis. It is prudent positioning, meaningful exposure to the themes that benefit from the structural reality, appropriate hedging against the tail risks, and sufficient liquidity to survive the volatility and remain opportunistic. Closing, the edge that understanding gives you. Let me close with something personal, because I want to be direct about what this channel is trying to do and why it matters in a moment like this one. The gap between what most people understand about global economic and financial dynamics and what serious professional investors understand is enormous at the best of times. In a crisis, in a moment like this one, when the news is loud and confusing and frightening, that gap becomes even larger. And the consequences of being on the wrong side of that gap become more severe. Most people, when they turn on the news and see missiles and hear about oil prices and watch their portfolio values fluctuate wildly, feel helpless. They either do nothing, paralyzed by uncertainty, or they react emotionally, making decisions driven by fear rather than analysis. They sell when they should hold. They hold when they should reposition. They miss the opportunities that crises always create for those with clear eyes and steady hands. The purpose of this channel is to close that gap, not to make you fearless. Appropriate caution in dangerous environments is wisdom, not weakness, but to give you the analytical tools, the frameworks, the cause and effect understanding that allows you to process what is happening clearly, to separate the signal from the noise, to identify the temporary from the structural, to know when the fear is rational and when it is overdone, to see the opportunities that hide inside the disruption. The 2026 Iran conflict is one of the most significant geopolitical and economic events of our generation. It is already reshaping energy markets, military strategies, diplomatic alliances, supply chains, and inflation dynamics in ways that will persist for years. For investors, it is both a risk to be managed and an opportunity to be captured, if you have the clarity to see it correctly. The geopolitical bloc dynamics we discussed tell you that this is not a story that resolves cleanly in weeks. Position accordingly. The Strait of Hormuz analysis tells you that energy prices will remain volatile and elevated until the physical security of that waterway is restored. Track the signals. The cyber warfare dimension tells you that unexpected, sudden disruptions to financial and energy infrastructure remain possible. Maintain defensive positions accordingly. The 3 oil scenarios give you a framework for understanding what trigger events to watch and what market responses to expect. Use that framework actively. The defense spending supercycle tells you that certain sectors have genuine, multi-year structural tailwinds that go well beyond the immediate conflict. Build exposure intelligently. China's long game tells you that the geopolitical competition reshaping global trade and finance is playing out across decades, not months. Think with a long horizon. And the end of globalization as we knew it tells you that the investment assumptions of the last 30 years need to be re-examined, not just at the margins but fundamentally. This is the moment for clarity. This is the moment for analysis over emotion. This is the moment to be the investor who understands what is happening while everyone else is just reacting to it. Thank you for spending this time with Profit Pulse. If this episode helped you see this situation more clearly, if it gave you a framework that you will actually use in your thinking and your decision-making, please share it. Because the more people who understand what is really happening in this world and what it means for their financial futures, the better off we all are. This has been part 2 of our 2026 Iran War series. Stay informed, stay analytical, stay positioned with clarity and conviction, and we will see you in the next one. If you have been following this series from the beginning, you already have more context about this conflict than most people watching mainstream financial news. In part 1, we built the timeline. We walked through how this war started, why it started, and how the first shockwave hit global markets. In part 2, we went deeper. We talked about the hidden geopolitical chessboard, the block dynamics between East and West, China's long game, the cyber warfare dimension, and why the end of globalization as we knew it is not a headline but a structural economic reality unfolding in real time. Today, in part 3, we are bringing it fully into the present moment, because the situation has changed since we recorded those first 2 episodes. It has changed significantly, and the changes are not small, incremental updates. They are the kind of developments that shift the entire trajectory of a conflict. The kind that force markets to reprice, that force governments to make decisions they had been hoping to avoid, and that force investors to ask hard questions about whether the positions they were comfortable holding 2 weeks ago still make sense today. We are now in week 3 of this war, and week 3 looks nothing like week 1. Week 1 was shock. Week 2 was reaction and adjustment. Week 3 is something different, something more ominous. Week 3 is the phase where the early hope of a quick resolution has faded, where both sides have demonstrated their willingness and capability to sustain the conflict, and where the decisions being made right now, military decisions, diplomatic decisions, economic decisions, will determine whether this war stays contained or becomes something the global economy cannot absorb without severe damage. So let us get into it, because there is a lot to cover. And every single thing we are going to discuss today connects directly to what is happening in your portfolio, in your economy, and in the world that you and your money are living in. Part 1 of this episode, where we are right now, the numbers that change everything. Let me start with the hard numbers. Because in financial analysis, we always come back to data. And the data coming out of this conflict in its 3rd week is alarming in ways that deserve to be stated plainly and clearly. Iran has now launched more than 290 missiles at Israel and regional targets. More than 500 drones have been fired. Let me say those numbers again, because they are extraordinary. 290 missiles, 500 drones, and these are not the figures from the entire history of any previous Middle Eastern conflict. These are the figures from 3 weeks of a single conflict. 3 weeks. To put that in perspective, the scale of Iran's retaliatory strike campaign has exceeded what most military analysts predicted Iran was capable of sustaining over that time period. The assessment before this conflict began was that Iran could conduct a significant retaliatory strike and would then face serious constraints, logistical, political, and military, that would limit its ability to keep firing at that pace. Those assessments were wrong. Or more precisely, they underestimated either Iran's stockpiles, its production capacity, or its political determination to keep the pressure on regardless of cost. And the implications of that miscalculation flow directly into markets. Because when military analysts miscalculate the duration and intensity of a conflict, market analysts miscalculate too. The pricing of geopolitical risk, the risk premium embedded in oil prices, in equity valuations, in currency moves, was partly built on an assumption that this conflict would begin de-escalating within a couple of weeks. That assumption is now visibly wrong, and markets are in the process of repricing to reflect a conflict that is not winding down, but is instead escalating. Brent crude has now risen more than 40% since this war began. 40%. If you were holding oil-linked assets at the start of this conflict, that number represents an extraordinary return in a very short period. If you were holding airline stocks, consumer discretionary positions, or global manufacturing exposure, that same number represents a significant loss of value. United States equity markets have fallen roughly 4% from their pre-conflict levels. That is a moderate decline, not a crash. And its modesty is telling us something important that we will explore throughout this episode. The market, for now, still believes this conflict can be contained. It is not pricing in the worst-case scenario, which means that if the worst-case scenario begins to materialize, the adjustment from current prices to crisis prices could be sudden and severe. 140 United States service members have been wounded in Gulf area attacks, according to Pentagon statements. That number will likely grow as the conflict continues. And every time American casualties increase, the domestic political dynamics in the United States shift in ways that can affect military decision-making and escalation choices. Political pressure to respond more forcefully builds. The calculus of restraint versus retaliation changes. These are the numbers that define the current moment. Hold them in your mind as we work through everything that follows, because they are the factual foundation upon which everything else rests. Part 2 of this episode, the Karg Island strike. The single most important event of Week 3 of all the developments in the third week of this conflict. One stands above everything else in terms of its strategic and market significance. One event that, when you understand what it means and what it signals, explains more about where this war is heading than almost anything else. That event is the United States bombing of Karg Island. Let me explain what Karg Island is, why it matters, and why the decision to strike it, and the specific way in which it was struck, is perhaps the most consequential military and economic decision made in this conflict so far. Karg Island is a small island in the Persian Gulf, roughly 25 kilometers off the coast of southwestern Iran. In geographic terms, it is unremarkable, but in economic terms, it is one of the most important pieces of real estate on Earth. Karg Island is where approximately 90% of Iran's oil exports are loaded onto tankers. 90%. The vast majority of the oil that Iran produces and sells to the world, the oil that funds the Iranian state, the Iranian military, Iran's proxy network, and Iran's nuclear program, passes through the export terminals on Karg Island. Think about what that means strategically. Karg Island is Iran's economic lifeline. It is the valve through which Iran's primary source of national revenue flows. Without the ability to export oil through Karg Island, Iran's economic position becomes desperate in a very short period of time. Now, the United States conducted precision strikes on Karg Island. More than 90 military sites on the island were targeted, including missile installations and naval infrastructure. The message was direct, deliberate, and unmistakable. We know where your lifeline is. We can reach it. We can hit it. But here is the strategically fascinating and market-critical detail. The oil facilities themselves were intentionally spared. The United States struck the military infrastructure on Karg Island, but deliberately avoided hitting the oil loading terminals, the storage facilities, and the export infrastructure. And simultaneously, American officials made very explicit statements to the effect that this restraint was conditional. That if Iran continues its missile and drone campaign at the current level, or escalates further, oil infrastructure could become a target in the next phase. This is a form of coercive diplomacy, as old as warfare itself. The message is, we have shown you that we can destroy your ability to export oil. We have chosen not to yet. But we are standing here, visible, with the capability and the stated willingness to do so if you force our hand. The question we are posing to you is continuing this conflict worth the destruction of your oil export capacity? Now let us trace the cause and effect of this strategic choice through the market. In the immediate term, the strike on Karg Island and the news of what was hit and what was spared sent oil prices upward. Because the market immediately registered two things simultaneously. First, the war has escalated to directly targeting one of the world's most important oil export nodes. Second, Iran's primary export terminal is now potentially in the crosshairs of the most powerful military on Earth. Both of those facts are bullish for oil prices. The first because it raises the fear premium around oil supply disruption. The second because it puts Iran's production and export capacity directly at risk in a way that was previously theoretical but is now demonstrated and real. But there is a second-order effect that is equally important, and it is the effect on Iran's decision-making. The United States has essentially handed Iran a very explicit choice. You can keep firing missiles and drones. We will keep degrading your military infrastructure. And if you keep going long enough and hard enough, we will take your oil export capacity offline. Permanently. For Iranian leadership, that threat has to be calculated against domestic political imperatives. On one hand, backing down from the confrontation would be seen domestically as capitulation under military pressure, deeply damaging to the regime's legitimacy and authority. On the other hand, losing the ability to export oil would mean losing the revenue that funds everything the Iranian state does. It would mean a level of economic suffering for the Iranian population that could threaten regime stability from a completely different direction. This is the strategic trap that the Karg Island strike was designed to create, and the decision that Iranian leadership makes in response to that trap, in the days and weeks immediately following the strike, will be the single most important determinant of where this conflict goes next. For investors, the Karg Island development means that oil infrastructure is now explicitly in play as a potential target in this conflict. That alone should raise the risk premium you are assigning to energy supply uncertainty. Because even if Iranian oil facilities are ultimately spared, the fact that they are now credibly threatened creates a higher floor for oil's fear premium than existed before the strike. Part 3 of this episode: 290 missiles and 500 drones. What Iran's firepower tells US. Let us stay with the military dimension a bit longer, because there is something in the scale of Iran's missile and drone campaign that carries specific and important information for investors and analysts. When Iran fires 290 missiles and 500 drones in 3 weeks, it is telling you several things simultaneously. And each of those things has economic and market implications. The first thing it tells you is that Iran's stockpiles of these weapons are significantly larger than publicly acknowledged pre-conflict estimates. Intelligence assessments had put Iran's missile stockpile at figures that suggested this level of sustained campaign would severely deplete reserves within weeks. The fact that Iran has maintained this tempo for 3 weeks and shows no signs of dramatic reduction suggests either that the stockpile estimates were significantly wrong, or that Iran is receiving replenishment from Russia, from North Korea, from domestic production, fast enough to maintain the campaign. The market implication: if Iran's supply of weapons is larger or more resilient than expected, the conflict will last longer than the base case assumed. Longer conflict means higher oil prices for longer. Higher oil for longer means more inflation pressure for longer. More inflation pressure for longer means central banks stay restrictive for longer. And that entire chain has significant implications for equity valuations, bond prices, and economic growth expectations. The second thing the scale of Iran's campaign tells you is about the effectiveness of air defense systems. Israel's Iron Dome and Arrow systems, combined with American Patriot and THAAD batteries positioned in the region, have been intercepting large numbers of Iranian missiles and drones. But not all of them. Iranian weapons have gotten through. Israeli cities have been struck. United States bases have been struck. Gulf state targets have been struck. This has 2 market implications. First, it means the conflict's human and infrastructure cost is real and ongoing, which sustains the geopolitical risk premium. Second, and more interesting from a longer-term investment perspective, it means that the world has just witnessed the most extensive real-world combat test of modern air defense systems in history. Every government on Earth is watching the performance data from this conflict. Every military planner is assessing what capabilities were effective and what were not. And the conclusions they draw will drive procurement decisions, defense spending decisions, for years. The air defense manufacturers whose systems performed well are entering a period of extraordinary demand. The third thing Iran's sustained campaign tells you is about political determination and domestic political constraints. The Iranian leadership is accepting the costs of this conflict: the military damage, the economic disruption, the international isolation, and continuing to fight. That tells you something about how they are calculating the political cost of stopping versus the political cost of continuing. And what it tells you is that a quick diplomatic resolution is significantly less likely than the optimists were hoping. Part 4 of this episode, the war is spreading. Bahrain, Kuwait, Jordan, and what regional expansion means. One of the most alarming developments of Week 3 is geographic. And it is a development that directly validates one of the central warnings we made in Part 2 of this series. The conflict is no longer geographically limited to Iran and Israel. Iranian missile and drone attacks have now struck targets in Bahrain, Kuwait, and Jordan. These are countries that host American military assets and serve as logistical nodes for American and allied military operations in the region. By targeting them, Iran is doing two things simultaneously, each of which carries significant strategic and market implications. First, Iran is attempting to impose costs on the countries that are providing infrastructure support for the American military campaign. The message is, if you allow your territory to be used against us, your territory becomes part of this war. This creates enormous political pressure on Gulf governments that are deeply uncomfortable with the choice they are being forced to make. They want American protection. They do not want Iranian missiles landing in their cities. Second, Iran is demonstrating the geographic reach of its strike capabilities. The ability to hit targets in Bahrain, Kuwait, and Jordan from Iranian territory, while simultaneously conducting operations against Israel and managing the Strait of Hormuz situation, is a demonstration of military reach that has impressed and alarmed analysts in equal measure. Now, why does this geographic expansion matter so critically for markets? It matters because it moves the conflict progressively closer to the threshold that investors are most afraid of: direct involvement of major Gulf oil producers. Bahrain, Kuwait, and Jordan are not oil superpowers. Their involvement in the conflict as targets of Iranian attacks is deeply concerning from a human and political standpoint, but its direct impact on global oil supply is limited. Saudi Arabia and the United Arab Emirates are a completely different story. And the geographic spread of Iranian attacks toward the broader Gulf region raises a question that every oil market analyst is now asking publicly. How close is this to the Saudi border? How close is this to Emirati infrastructure? And at what point does the government of Saudi Arabia feel that its own security requires a direct response? Cause and effect. Iranian attacks spread geographically across the Gulf. Gulf states come under direct military threat. Saudi Arabia faces a choice between accepting those threats and enduring them, or taking military action in response. If Saudi Arabia takes military action, it becomes a combatant, not a bystander. And as a combatant, its oil production becomes a potential target. That chain of events, if it runs to completion, is the most severe supply shock scenario we outlined in Part 2. The market is watching this geographic spread with extreme attention. Every new country that appears in the list of Iranian attack targets is another step down that chain. Another data point suggesting that the regional war scenario is closer than the base case assumes. Part 5 of this episode, Iran's proxy network. The multiplier that makes this war impossible to contain there is something fundamentally different about this conflict compared to most of the geopolitical crises investors have navigated in recent decades. And that difference is Iran's proxy network. Understanding it deeply, specifically, operationally, is essential to understanding why this war cannot be contained the way a simpler bilateral conflict could be. Iran does not fight primarily through its own military forces in the way that, say, the United States or Russia does. Iran fights primarily through a network of armed groups it has spent decades funding, training, equipping, and directing across the Middle East. This network, sometimes called the axis of resistance, is Iran's strategic multiplier. It allows Iran to project power and impose costs on adversaries in multiple countries simultaneously, while maintaining a degree of deniability and while preserving its own regular military forces. The major components of this network are well documented. Hezbollah in Lebanon is the most capable and most powerful of these groups. It has more precision-guided missiles than many regular national armies. It has battle-hardened fighters who have been in continuous conflict for decades. And it sits on Israel's northern border, within striking distance of major Israeli cities and critical infrastructure. Hezbollah has been launching rockets into Israel throughout this conflict, but as of the third week, it has not yet fully committed its forces. It is as if Hezbollah is running its engines at a moderate throttle, maintaining pressure without yet deploying its full capability. The question of when, if ever, Hezbollah fully activates is one of the most important and most watched questions in this conflict. If Hezbollah fully enters the war, if it launches a comprehensive assault on northern Israel using its full missile and rocket arsenal, Israel would be fighting on two simultaneous fronts at significant intensity. That would require a dramatic escalation of Israeli military operations, including potential ground operations in Lebanon, which would deepen and lengthen the conflict enormously. The militias in Iraq are a different but equally concerning dimension. Iran-backed groups in Iraq have been attacking American bases throughout the conflict. The strike near the United States Embassy in Baghdad that we discussed in Part 1 was a signal of their capability and willingness to target even the most symbolically important American facilities. These groups can disrupt American military logistics, create domestic political pressure in the United States, and force American military resources to be divided across multiple fronts. The Houthis in Yemen have been disrupting Red Sea shipping for over a year, but the current conflict has given them both greater motivation and potentially greater capability to intensify those disruptions. The Red Sea route is separate from the Hormuz route but equally critical for certain cargo flows, particularly trade between Asia and Europe through the Suez Canal. With both routes under pressure simultaneously, the global shipping network is being squeezed from multiple directions at once. Now let us trace the market implications of the proxy network with the cause and effect specificity that this channel is committed to. When Iran's proxy network activates across multiple fronts simultaneously, it does something that is deeply difficult for market pricing models to handle. It creates uncertainty that is geometrically larger than the sum of the individual threats. Because each proxy represents a separate escalation vector, a separate potential trigger for a new phase of the conflict, a separate set of decisions being made by local commanders and local political actors who are not perfectly controlled by Tehran. Multi-front conflicts do not just cost more, they last longer. They create more opportunities for accidental escalation, for misidentified targets, for miscalculated responses, for incidents that were not intended but that trigger consequences nobody wanted. And the longer and more complex a conflict becomes, the higher the sustained geopolitical risk premium in markets. For investors, the proxy network activation means one very specific and very important thing. The base case of a 2 to 3 month conflict with manageable economic disruption is becoming progressively harder to defend. The probability mass is shifting toward scenarios where this conflict lasts longer, spreads wider, and costs more in every sense of that word than the initial market pricing assumed. Part 6 of this episode, the Red Sea Crisis. The second shipping choke point that is strangling global trade. We have spent considerable time in this series discussing the Strait of Hormuz. And rightly so, it is the most directly important shipping route for energy. But there is a second shipping crisis unfolding in parallel that is receiving less attention than it deserves, and that has significant independent implications for global trade, global inflation, and global supply chains. I am talking about the Red Sea. The Red Sea is the waterway that connects the Gulf of Aden in the south to the Suez Canal in the north. It is the passage through which cargo ships traveling between Asia and Europe would normally transit, entering from the south after rounding the Horn of Africa, passing up through the Red Sea, transiting the Suez Canal, and emerging into the Mediterranean heading for European ports. This is one of the most important trade routes in the world. Roughly 12 to 15% of global trade, not just energy, but manufactured goods, electronics, clothing, agricultural products, chemicals, and virtually everything else that moves between the manufacturing centers of Asia and the consumer markets of Europe, passes through this corridor under normal conditions. It was already under pressure before the 2026 Iran conflict began. The Houthis in Yemen had been conducting attacks on commercial shipping in the Red Sea and Gulf of Aden since late 2023, as a form of pressure related to the Gaza conflict. Major shipping companies had already begun rerouting vessels around the Cape of Good Hope, the southern tip of Africa, rather than risk the Red Sea. The current conflict has dramatically intensified that pressure. With Iran and its proxy network in a state of full military confrontation with the United States and Israel, the Houthis have both greater motivation and greater implicit support for their disruption campaign. The attacks on shipping have intensified. The risk of transiting the Red Sea has risen further. The result is a shipping crisis that, when combined with the Hormuz disruption, creates a kind of geographic pincer movement on the global trade network. The eastern entrance to the global trade routes through Hormuz is under threat. The alternative passage for European trade through the Red Sea and Suez is also under threat. Ships are being pushed to the only remaining option, the long way around Africa. And that option has profound economic consequences. Let me give you the specific numbers, because they matter for understanding the inflationary implications. Rerouting a cargo ship from Asia to Europe around the Cape of Good Hope, instead of through the Suez Canal, adds approximately 10 to 15 days to the voyage. Depending on the specific route and vessel speed, it can be even more. That additional 10 to 15 days means additional fuel costs. It means crew costs. It means delayed delivery of goods, which has knock-on effects for the businesses waiting for those goods to arrive. And it means that the same number of ships can carry less total cargo per year, because each voyage takes longer, which effectively reduces global shipping capacity. Lower effective shipping capacity means higher freight rates. Higher freight rates mean higher costs for importers. Higher costs for importers mean higher prices for consumers. And higher prices for consumers is inflation by a different name, working through a different channel. The cause and effect chain is precise and traceable. Red Sea disruption forces rerouting. Rerouting increases voyage length and cost. Increased shipping cost translates to higher goods prices. Higher goods prices add to inflation. Higher inflation pressures central banks to keep rates elevated. Higher rates for longer suppress economic growth. Suppressed economic growth adds to recession risk. And recession risk, combined with inflation risk, brings us back to the stagflation scenario that we identified in Part 1 as the most dangerous macro outcome of this conflict. For investors tracking global supply chain companies, logistics providers, and consumer goods manufacturers with complex international supply chains, the Red Sea situation adds another layer of cost and uncertainty on top of the Hormuz energy shock. These companies are facing cost pressures from multiple directions simultaneously. Their earnings guidance is going to reflect that, and the market will respond. Part 7 of this episode, oil at 104 and rising. The 3 critical price levels that will determine everything Brent crude is now trading above $104 per barrel. Oil has surged more than 40% since this war began, and the trajectory, based on everything we have discussed today, is pointing upward, not downward. But oil price is not a single number. For investors and analysts, the oil price is a series of threshold levels, each with a different set of market and economic implications. And understanding those thresholds, knowing exactly what each level means, why it matters, and what it triggers, is one of the most practical and actionable things you can take from this episode. The first critical threshold is $100 per barrel. We crossed through this level in the first week of the conflict. $100 is the psychological and analytical barrier that separates elevated but manageable energy costs from genuinely disruptive energy costs. Below $100, the economic impact of higher oil is significant but absorbable. Above it, the damage begins compounding. At $100 oil, airlines are bleeding. Consumer discretionary spending is under meaningful pressure. Central banks are uncomfortable but not in crisis mode. The global economy is slowing but not contracting. Markets are volatile but not in panic. We are at $104 right now. We have crossed the threshold. The economic damage is real. The question is whether oil stabilizes and consolidates in the 100 to 110 range. The controlled conflict scenario we mapped in Part 2 or whether it breaks through to the second critical threshold. The second threshold is $120 per barrel. This is the level that analysts identify as the beginning of serious global economic distress. At $120 oil, the inflation implications are severe enough to force central bank hands. Rate cuts get pushed off the table entirely. Some central banks may be forced to resume hiking. The recession probability begins rising above 50% in most forecasting models. At $120 oil, the earnings picture for most non-energy companies deteriorates significantly. Airlines face existential cash flow crises. Consumer companies see demand softening rapidly. Manufacturing margins compress. Technology companies, insulated at $100 oil, begin feeling the demand destruction from a slowing broader economy. The signal that will tell you whether we are heading toward 120 is the Hormuz situation. If tanker traffic declines further, if the rate of flow through the strait drops materially from current levels, that is the supply squeeze that pushes us through this threshold. Watch the satellite data. Watch the insurance markets. Watch the shipping company announcements. Those are your leading indicators for whether the oil price is going to break above 120. The third threshold, the one that most serious analysts do not want to discuss publicly because it represents such a severe scenario, is $150 per barrel and beyond. This is the territory of the regional war scenario, the territory where Saudi production is disrupted, where Gulf state oil infrastructure is under active military threat, where the supply removal from global markets is severe enough to create genuine energy scarcity rather than just fear of scarcity. At $150 oil, global recession becomes essentially certain in most forecasting models. Stock markets face potential crashes, not corrections crashes. Central banks face an impossible policy environment. Consumer confidence collapses. The economic damage is severe, broad, and lasting. Nobody wants to be at $150, but the path to get there exists, and it runs through the decisions being made right now by the Iranian government in response to the Karg Island strike, by the Houthi leadership in response to American counter-operations, and by the Saudi government in response to the geographic spread of conflict toward its borders. Right now, at $104, we are in the zone between threshold 1 and threshold 2. The economic damage is real but manageable. The market is pricing in a scenario that does not reach threshold 2. If that pricing is correct, the situation, while difficult, is navigable. If the pricing is wrong, if the conflict escalates in ways that push oil toward or through 120, the adjustment from current market levels to crisis price levels will be sharp, fast, and painful for anyone not positioned for it. Part 8 of this episode, the intelligence war inside Iran. What hundreds of arrests tell US there is a development from inside Iran in the third week of this conflict that has received relatively little attention in financial media, but that carries significant signal value for analysts trying to understand the war's trajectory. Iranian authorities have arrested hundreds of people inside Iran on charges of being intelligence assets for Israel and the United States. Hundreds of people, in a single country, in a single week. Now let me be careful about how I interpret this, because there are two very different possibilities here, and distinguishing between them matters. The first possibility is that the arrests represent genuine counterintelligence success, that Iran has actually identified and detained a significant network of foreign intelligence assets operating inside Iranian territory, providing information to American and Israeli military planners about targets, personnel movements, and infrastructure vulnerabilities. The second possibility is that the arrests are primarily a domestic political exercise, a display of vigilance by the regime designed to suppress internal dissent, justify the continuation of the war, and demonstrate that the government is actively managing security threats. In all likelihood, it is some combination of both. Large-scale intelligence arrest campaigns in authoritarian states during wartime almost always involve genuine counterintelligence activity mixed with opportunistic political suppression. But here is what the arrests tell investors and analysts regardless of which interpretation is more accurate. If genuine intelligence networks inside Iran have been rolled up, if the human sources providing real-time information about Iranian military movements and facilities have been identified and removed, then the quality of American and Israeli targeting intelligence will likely degrade over time. Future strikes may be less precise. Future targeting decisions may be made on less complete information. And less precise military operations carry higher risks of the kind of accidental escalation, the struck civilian facility, the misidentified target, that we identified in Part 2 as one of the most dangerous sources of unintended conflict escalation. The cause and effect here is subtle but real. Intelligence degradation reduces targeting precision. Reduced targeting precision increases the probability of incidents that either cause unintended civilian casualties or that hit targets, including potentially in neutral or non-combatant countries, that were not authorized. Unintended strikes of that nature can trigger political crises, diplomatic incidents, and escalation pressure that the original planning did not intend and that nobody's decision trees had mapped out. And for markets, the prospect of accidental escalation, of incidents that nobody planned and nobody wanted, is particularly toxic. Because the market can price deliberate escalation steps. It can model the probability of a decision being made and calibrate its response. What the market cannot price is a truly random and unexpected incident that suddenly changes the entire political dynamic. Those events create the kind of sudden, violent market moves that leave investors unable to hedge or reposition in time. The intelligence war inside Iran is, therefore, not just a military story. It is a market risk story, and it belongs in any serious investor's framework for thinking about this conflict. Part 9 of this episode, the United States military buildup. Reading the aircraft carriers, one of the clearest and most reliable signals of American strategic intent in any regional conflict is the aircraft carrier. The United States Navy's carrier strike groups are the most powerful conventional military instruments on Earth. Each one represents an enormous concentration of offensive and defensive capability. And when the United States moves multiple carrier strike groups toward a theater of operations, it is sending a message that no serious military analyst misreads. Additional carrier groups are now moving toward the Persian Gulf. This is significant on multiple levels, each of which matters for investors trying to assess the conflict's trajectory. First, it tells you about American military planning. You do not move carrier groups toward a region unless you are preparing for the possibility of operations that require the kind of offensive firepower and sustained presence that only carrier groups can provide. Carrier deployments are expensive, logistically complex, and politically visible. They are not done lightly or as pure posturing. The deployment of additional carriers says, the United States military is preparing for a scenario in which the current level of operations proves insufficient. It is building capacity for a higher level of engagement, even if it hopes that capacity will not be needed. Second, the carrier deployment is accompanied by expanded Patriot and THAAD missile defense battery deployments across the Gulf region, and by increased fighter jet patrol activity. Patriot and THAAD batteries are defensive systems, designed to intercept incoming missiles and drones. Their expanded deployment tells you that the American military is preparing for a sustained campaign by Iran to target American and allied assets, and is working to ensure it has adequate defensive capability to absorb that campaign without unacceptable damage. Third, and this is the most important market signal from the military buildup, the presence of multiple carrier groups in a relatively small geographic area increases the probability of a direct naval confrontation between American and Iranian forces. The Persian Gulf is not a large body of water. American naval vessels and Iranian naval vessels are operating in close proximity. Iranian fast attack boats, submarines, and anti-ship missiles are in range of American ships. American aircraft and missiles are in range of Iranian vessels and facilities. In that environment, the probability of an incident, a miscommunication, a misidentified contact, an act of aggression by either side that triggers an immediate and escalatory response, is meaningfully higher than in a larger theater where forces have more room to maneuver and more time to assess before acting. Cause and effect. More forces in closer proximity increases the probability of confrontation or incident. Confrontation or incident between American and Iranian regular military forces would be a qualitatively different escalation than anything that has happened so far in this conflict. It would be a direct military engagement between the armed forces of Iran and the armed forces of the United States, not via proxies, not via allies, but directly. The market implications of such an incident would be immediate and severe. Oil would spike, equities would sell off sharply, safe havens would surge. This is not a prediction, it is a probability assessment. The military buildup is a signal that the probability has risen, not that it will materialize. But it is a probability that every serious investor should have explicitly in their risk framework right now. Part 10 of this episode, the inflation return. What this means for central banks and your stock market, let me bring the economic analysis fully up to date for the current moment. Because the inflation picture has evolved significantly since the conflict began, and the implications for markets are substantial. Before this war started, the consensus view among economists and central bank watchers was cautiously optimistic. Inflation in the United States and Europe had been falling steadily for over a year. The Federal Reserve, the European Central Bank, the Bank of England, all of them were in various stages of transitioning from a tightening posture to an easing posture. Rate cuts were on the table. The conversation had shifted from when will they stop hiking to how fast will they cut. That conversation has now been entirely disrupted. When oil rises more than 40% in 3 weeks, it does not just add to current measured inflation. It changes the entire forward inflation outlook. It forces central bank economists to revise their inflation projections upward. It delays the point at which inflation returns to target. And it changes the political and analytical calculus for rate decisions. Let me walk you through the specific cause and effect chain, because it has specific timing implications for markets. The oil price increase flows through to consumer prices with a lag. The first and fastest channel is gasoline prices, which respond within days to crude price movements. Gasoline is the most visible price in the economy. People see it every time they drive past a gas station. And when it rises rapidly, it has both a direct impact on household budgets and a psychological impact on consumer confidence and inflation expectations. The second channel is transportation costs, which affect the price of virtually everything delivered to stores and warehouses. This channel operates with a lag of several weeks to a couple of months, as contracts are renegotiated and cost increases work their way through supply chains. The third channel is broader industrial and manufacturing costs, which respond with a lag of 1 to 3 months as energy-intensive businesses see their cost structures change and begin passing those increases forward into their own pricing. The cumulative effect of these 3 channels means that the full inflationary impact of the current oil price spike will not be fully visible in consumer price data for several months. Which means that when central bank governors are sitting down in their next policy meetings, in April, in May, in June of 2026, they will be looking at inflation data that is still absorbing the shock from the conflict that began in late February. The implications for monetary policy are direct. The Federal Reserve's next meetings will face a deeply uncomfortable combination of signals. Energy-driven inflation is rising. Economic growth is slowing under the weight of energy costs and uncertainty. This is the classic stagflation setup, and the policy response to stagflation is genuinely agonizing because the standard tools work in opposite directions. If the Fed cuts rates to support a slowing economy, it risks amplifying the inflation rebound. If it holds rates to fight inflation, it risks pushing an already stressed economy into recession. If it raises rates, which some analysts are beginning to suggest may become necessary if inflation reignites aggressively, it would be devastating for equity valuations, particularly for growth stocks that have been priced on the assumption of declining rates. The market is currently pricing the Fed as holding rates steady through mid-year, with possible cuts in the second half of 2026. That pricing reflects the base case assumption that the conflict stabilizes and the oil shock begins subsiding. If the conflict does not stabilize, if oil pushes toward and through 120, that market pricing for the Fed is wrong. And the adjustment from wrong pricing to correct pricing in interest rate markets is one of the most powerful forces that can move equity markets. For investors, this means that the Federal Reserve is now a secondary indicator in this crisis, not the primary one, but deeply important. Watch what Fed officials say about inflation in their public communications. Watch whether the language shifts from patient neutrality toward concern about energy-driven price pressures. That language shift will be your earliest warning signal that the rate environment is about to become more challenging for equities. Part 11 of this episode: what is working and what is not. An honest assessment of market behavior. I want to spend some time on something that has surprised a number of analysts, and I want to be honest about it rather than fitting the narrative neatly into a predetermined framework. Because intellectual honesty is more useful to investors than narrative convenience. The surprise is this: global equity markets, despite everything that has happened in 3 weeks of this conflict, have only fallen about 4% from pre-conflict levels. 4%. For context, that is a relatively normal market fluctuation. It is not nothing, but it is also not the kind of dramatic, sustained sell-off that many analysts, including thoughtful ones, expected from a conflict of this magnitude. What does that tell us? It tells us one of several things, or possibly a combination of several things. The first interpretation is that the market is correctly pricing the situation. That professional investors, on balance, believe the conflict will remain in the controlled conflict scenario, that oil will not break catastrophically higher, that the global economy will slow but not enter recession, and that corporate earnings will be affected but not devastated. This interpretation says the market is being rational, not complacent. The second interpretation is that the market is being complacent, that it is underestimating the probability of escalation scenarios, that the 4% decline represents insufficient risk pricing for a conflict that could, with a single significant escalation event, a fully committed Hezbollah, a Karg Island oil facility strike, a direct American-Iranian naval confrontation, rapidly move from managed uncertainty to genuine crisis. The third interpretation is more structural. It says that equity markets have become somewhat desensitized to geopolitical risk events in recent years. The Russia-Ukraine conflict, despite its severity, did not cause a sustained global equity bear market. Markets recovered and pushed higher even as the conflict continued. The COVID pandemic caused a sharp but brief equity crash before an extraordinary recovery. Markets have a recent track record of absorbing geopolitical shocks more resiliently than historical patterns would predict. If investors are applying that recent track record to the current situation, if they are essentially betting that this conflict, like previous ones, will be absorbed by a resilient global economy and resilient corporate earnings, then the current pricing makes a kind of sense. It is not irrational given the recent evidence. But here is the honest caveat that every investor needs to carry: the asymmetry of this situation is unusual. If the market is right, if the conflict stays controlled, the upside from here is modest. A resolution rally, defense and energy profits, eventual normalization. These are positive outcomes, but not spectacular returns from current levels. If the market is wrong, if the conflict escalates materially, the downside from current levels could be severe. A 4% decline is not adequate cushioning against a scenario in which oil goes to 150 and global recession becomes the consensus forecast. The asymmetry of a relatively small potential gain versus a potentially large potential loss is the core argument for maintaining meaningful defensive positioning even as markets appear relatively calm. It is not a prediction of catastrophe. It is a sensible acknowledgement that the current pricing does not fully reflect the risk distribution. Part 12 of this episode, Gold, Currencies, and the Hidden Signals in Financial Markets. Let me now look at the signals that financial markets other than equities are sending. Because equities are just one part of the picture, and in some ways not the most informative part right now. Gold has been rising steadily throughout this conflict. Not dramatically and all at once, that would suggest pure panic buying, but steadily, persistently, day after day, as a sustained accumulation from investors who are choosing to allocate a portion of their portfolios to the oldest and most reliable form of financial insurance known to human civilization. The pattern of gold's rise tells you something specific and important. When gold rises in a sudden spike, it reflects acute fear, the kind of fear that is as likely to reverse as it is to persist. When gold rises steadily over weeks, it reflects a growing conviction among a broad set of investors that the period of elevated uncertainty is not going to end quickly. It reflects deliberate, strategic hedging rather than panic buying. Central banks have been among the buyers. Central bank gold purchases had been at historically elevated levels even before this conflict, a trend driven by the desire of many central banks, particularly those in emerging markets and geopolitically vulnerable countries, to hold more reserves outside the dollar-dominated financial system. This conflict has given that trend additional impetus. When you are a central bank watching the United States use its financial system as a weapon, through sanctions, through asset freezes, through exclusion from dollar clearing, you look at your gold reserves and you think, this is the one asset that cannot be frozen, cannot be sanctioned, and does not require counterparty trust to retain its value. Currency markets are sending complementary signals. The United States dollar has strengthened against most emerging market currencies since the conflict began. This is the classic geopolitical risk pattern. Capital flows to the perceived safety of the dollar. But within that broader pattern, there are interesting divergences worth noting. The currencies of major oil exporters outside the conflict zone, the Norwegian krone, for instance, and currencies linked to Canadian oil production, have shown relative strength. This reflects the market pricing in higher revenues for these producers in the elevated oil price environment. The currencies of major oil importers, particularly emerging market economies in Asia and South America, have come under pressure. Higher oil prices mean higher import bills, deteriorating trade balances, and in some cases genuine balance of payment stress for countries that are already running deficits and borrowing in foreign currencies. The cause and effect chain for emerging market currencies is one of the more underappreciated dimensions of this crisis. Oil price rises, emerging market import costs rise, trade deficits widen, currency depreciates. Depreciated currency makes dollar-denominated debt more expensive to service. Debt service burden rises. In extreme cases, sovereign credit stress develops. And sovereign credit stress in a major emerging economy, which could be triggered or accelerated by the current conflict, is itself a source of global financial instability. For investors with emerging market exposure, this is a specific and important risk to assess. Not all emerging markets are equally vulnerable. Some are oil exporters who benefit from higher prices, and their currencies and economies perform better in this environment. But the oil-importing emerging markets, particularly those with significant dollar debt loads, are facing a compounding stress that deserves careful evaluation. Part 13 of this episode, what the next 30 days will determine. We are approaching the end of this episode, and I want to close by giving you something concrete and forward-looking. Because the past 3 weeks, as important as they are to understand, have already happened. The question that actually matters for your money is, what happens next? In my assessment, built on everything we have discussed across 3 episodes of this series, the next 30 days represent the most consequential decision period of this entire conflict. The decisions made by the key actors in the next 30 days will determine whether this crisis resolves in a way the global economy can manage, or escalates into something significantly more damaging. There are 3 critical decision points to watch. The first is Iran's response to the Karg Island strike. We discussed this in detail earlier. Iran has been handed an explicit choice: accept the military pressure and find a political formula for de-escalation, or continue the conflict and risk the destruction of the oil export capacity that funds everything the Iranian state does. The window in which that decision becomes visible, through either an escalation in attacks, A change in diplomatic signaling or something in between is the next 2 to 4 weeks. If Iran's response is another major round of missile and drone strikes at the current or higher intensity, markets will read this as Iran choosing to escalate. Oil will spike, the diplomatic window will narrow further. The scenario probabilities will shift toward longer conflict and higher economic cost. If Iran's response includes even subtle diplomatic signaling, a statement about humanitarian corridors, an expressed willingness to discuss conditions, a communication through Omani or Qatari intermediaries, markets will respond positively and quickly. Even a small probability of diplomatic progress is worth a significant oil price reduction when it emerges from an environment of this much uncertainty. The second critical decision point is the Trump administration's coalition-building effort to reopen the Strait of Hormuz. American officials have been publicly discussing efforts to assemble a coalition of naval forces and diplomatic pressure to restore commercial shipping through the strait. This is an enormously complex undertaking. It requires the cooperation of regional partners, the willingness of shipping companies to trust the security guarantees being offered, and either the neutralization of Iranian interdiction capabilities or a deterrence posture strong enough to discourage their use. If this coalition begins taking visible shape, if you see announcements of naval escort operations, if major shipping companies announce resumed Hormuz transits, if tanker traffic data begins recovering, that is the single most bullish scenario available from current market levels. Oil would fall rapidly, equity markets would rally, the inflation pressure would begin easing, central banks would regain the ability to cut rates. The economic damage, while real, would prove recoverable. If the coalition-building effort stalls, if regional partners are unwilling to participate, if the security guarantee cannot be made credible, if shipping companies continue refusing to send vessels through, then the supply disruption persists. Oil stays elevated or rises further. The economic damage compounds. The third critical decision point is the next significant military operation by either side. The nature and scale of the next major strike, whether by the United States, Israel, or Iran, will tell the market more about the conflict's trajectory than any statement or diplomatic communication. Military operations are the most credible signals of intent in a conflict. Words can be walked back, bombs cannot. If the next major strike is a proportionate, targeted operation aimed at specific military capabilities, another precision strike on infrastructure, another round of degrading Iran's missile production capacity, the market will read it as the conflict continuing on its current trajectory. Significant, damaging, but bounded. If the next major strike represents a dramatic escalation, a strike on Iranian oil facilities, a direct attack on civilian infrastructure, an action that brings additional regional actors directly into the conflict, the market response will be severe and rapid. And if the next major development is not a military strike but a ceasefire announcement, however fragile, however conditional, however subject to collapse, markets will react with extraordinary relief and extraordinary positive force. Closing, the most important thing you can do right now. We have covered an enormous amount of ground today. Week 3 of the conflict, the Karg Island strike and its strategic implications. 290 missiles and 500 drones, and what those numbers tell us. The geographic spread of attacks to Bahrain, Kuwait, and Jordan. Iran's proxy network, and why it makes containment so difficult. The Red Sea shipping crisis adding to the Hormuz disruption. The 3 critical oil price thresholds, and what each one triggers. The intelligence war inside Iran. The American military buildup, and what carrier deployments signal. The return of inflation, and what it means for central banks and your equity portfolio. The honest assessment of why markets have only fallen 4%, and why that might represent complacency. Gold and currencies, and the signals the broader financial market is sending. And the 3 critical decision points that the next 30 days will resolve. That is a lot of information, and information by itself is not the point. The point, the reason this channel exists, the reason I spend hours researching and scripting these episodes, is to turn information into understanding and understanding into better decisions. Because the investors who win in environments like this one are not the ones with the most data. They are the ones who can organize data into frameworks, frameworks into risk assessments, and risk assessments into portfolio decisions that protect and grow their capital over time. Here is the framework I want you to carry forward from this episode. The conflict is in a more dangerous phase than it was 2 weeks ago. The probability of escalation has risen, not fallen. The market's relatively calm 4% decline from pre-conflict levels may be pricing an optimistic scenario that the third week's developments are making harder to justify. In that context, maintaining meaningful exposure to the themes that benefit from the structural reality, defense, energy, gold, cybersecurity, domestic production, is not speculation. It is disciplined alignment between portfolio positioning and the actual world you are living in. Maintaining adequate liquidity to navigate continued volatility and to be opportunistic when moments of acute panic create genuine mispricings, as they always do in crisis environments, is not excessive caution. It is the mark of an investor who has internalized the lessons of every previous crisis, and maintaining the discipline to watch the specific signals we have identified. The Hormuz tanker traffic, the diplomatic temperature gauge, the oil price levels relative to the critical thresholds, the Federal Reserve's language, and the nature of the next major military development, is the daily practice that keeps your analysis current and your decision-making grounded in reality rather than in fear or false hope. The missiles and the drones are the visible part of this story. The numbers 290 missiles, 500 drones, $104 oil, 4% equity decline are the measurable part. But beneath all of those visible, measurable things, the real story is about two visions for how the world is organized competing for dominance, about an energy supply system that the entire global economy depends on coming under its most serious threat in decades, and about the decisions being made right now by a small number of people, in a small number of governments, that will determine whether this crisis is manageable or catastrophic. Your job as an investor is not to predict which path those decisions lead down. Your job is to be positioned for both possibilities, to be protected against the downside, to be exposed to the upside, and to be clear enough in your thinking that when the critical signal arrives, when the pivot toward de-escalation or the pivot toward escalation becomes visible, you can act decisively rather than reactively. This has been part 3 of the Profit Pulse 2026 Iran War series. Stay informed, stay analytical, stay positioned for a world that is changing faster than most people realize. And we will see you in part 4.